So now General Motors, check these shares out. They are under pressure in today's trade, and that is a double whammy for the company. Automaker reporting a third quarter earnings beat, but pulling its guidance over uncertainty tied to the UAW strike. And the union expanding its strike against GM. Union now targeting a Texas SUV plant. Joining us now is CFRA analyst Garrett Nelson and Greg Migliore, editor-in-chief of Autoblog, a Yahoo company. So, Greg, let me start with you right here. I'm just interested to get your take on the report, what you made of what GM had to say, and also just whether you think investors are even focused on this report. Or are they more focused on, listen, when there is a UAW deal, they're wondering about what are the labor expenses going to look like for GM and what it's going to mean for their bottom line?
Yeah, hey guys, thanks for having me. And I think really the headline here, the takeaway is that the strike has cost General Motors $800 million so far. This has gone on longer than the last strike in 2019 without a tentative agreement. I think really what we're seeing is some uncertainty with investors and really all industry watchers as far as what is going to happen next with General Motors. The UAW president, Sean Fain, is not playing around the edges. He's going, right at the Detroit 3 with strikes at big factories. The one most recently this morning, Arlington, they make the Cadillac Escalade, the Chevy Suburban, the large GMC trucks, truck-based SUVs. They're going right at the heart of the Detroit 3.
Yeah, they definitely are. And Garrett, when we talk about General Motors in particular here, I know it's hard to predict what's going to happen, but what's going to happen? Are they, what is it going to take to get to an agreement here?
Sure. Well, the two sides have come a lot closer in recent weeks. We are on day 40 of the strike. Everyone's asking, when is this going to end? We think probably in the next 1 to 3 weeks they'll come to an agreement. But what you're seeing more recently is the UAW walking out at the really high margin plants of the Detroit 3. So you saw, a very large Ford factory in Louisville a couple weeks ago. You saw Stellantis Ram 1500 pickup factory in Michigan yesterday, and then today GM's Arlington, Texas plant, which employs about 5,000 workers. So what we make of this is that the UAW is now really going after the high margin operations. They want to show the union members that they've done everything possible to drive the best labor deal before reaching an agreement, because they want a very high ratification total by the membership of any deal that they reach.
And Greg, the issues we talk about a lot here, yes, it's wages, it's cost of living adjustments, it's also these battery plants, Greg, and whether the workers there are going to be unionized. It sounds like GM made a concession there. Do you think Ford and Stellantis will make similar concessions on that issue?
I think at this point they're going to have to. With General Motors making that concession about a week ago, I think that really sort of paved the way for the other two Detroit companies to try to come to an agreement there. They still seem to be pretty far apart with retirement, 401k. It sounds like they've ironed out some things with like the wage tiers. That's definitely, had been a point of consternation. And then right now it's been a little, frankly, confusing which company seems to be perhaps in the lead position. For a while, it seemed like Ford might be at a better spot. Right now, Stellantis seems to be sort of in the pressure cooker with, what the UAW is going for. So it's become very uncertain as to like which company might sort of lead the pack out of this at this point.
And Greg, remind us here, even after the strike concludes, what's the then re-ramp up time? Like, do people just go back to the line and that's it? They start cranking out cars just like that once again?
Essentially, when the strike ends, and at some point it will end, and there will be a ratification process as well. The workers will return. There will be a little bit of a ramp up time, but I wouldn't expect it to be too long for these specific factories, because these factories all are building established products, very important products too. You're talking about some of the most lucrative, profit-driving, vehicles that the Detroit 3 make. But they're not like brand new products, if you will. Like they know how to make the F-150 and the Cadillac Escalade, but they will need some time to get these churning out and replenishing inventories, getting these to dealer lots. A lot of dominoes do need to kind of tip over before the Detroit companies are back at full strength.
Yeah, and Garrett, so let's put aside the strike for a moment, which I know is very difficult to do. How is GM doing otherwise, right? The company seemed to make some indications today in its commentary around earnings that it was on pace to hit the high end of its guidance if you take out strike costs. So what's your assessment of just broadly how GM is doing if you exclude the strike effects?
Sure. Well, it was a much better than expected quarter. And a big reason for that is, of course, the strike didn't begin until the second half of September. And because of the targeted nature of the strikes, really just a handful of factories. So it really it had a limited impact on GM's earnings in the third quarter. But looking ahead to the fourth quarter, there's a whole lot more uncertainty, of course, especially with the Arlington, Texas strike walkout this morning. And so that's why they've withdrawn their guidance for the full year. But still, if you look at the strikes, only about 31% of the UAW's membership is now on strike. So we would expect, when Ford and Stellantis report earnings, that there was also a fairly limited impact on their earnings for the quarter. But we would also expect those companies probably to withdraw their guidance for the full year, just given the uncertainty.
Yeah, makes sense. Garrett Nelson, Greg Migliore, thanks, guys. Appreciate it.